Hey there, and welcome. Today, we're going to learn how to decode a company's financial health. We're going to get way beyond just surface-level numbers and really understand the story they're telling us about how a business is actually doing. So let's jump right in. So let me start with a question for you. Is it possible for a business to have millions in sales, posting record-breaking revenue, and still be on the verge of totally failing? Well, the answer might surprise you, but it's a huge yes. And that right there is exactly why we have financial analysis. You can think of it as the ultimate lie detector test for any business. It's the tool that helps you cut through all the hype, all the noise, and shows you what's really going on under the hood.
To make this super simple, we're going to use an analogy for this whole explainer. See, looking only at a company's sales is kind of like staring at your car's speedometer. Sure, it's exciting to see you're going fast, but it tells you nothing about the engine overheating or, if you're about to run out of gas. We're here to learn how to read the entire dashboard.
So here's our game plan. We'll start by looking beyond that speedometer. Then we're going to dive into our three main sets of gauges on the dashboard. First, profitability, then liquidity, and then efficiency. After that, we'll cover how to spot those flashing red warning lights, and finally, how you can start thinking like a real analyst.
All right, first up, let's talk about the engine itself, profitability. These gauges, they tell us if the company is actually any good at turning sales into cold, hard cash. It really all boils down to that one simple question: are we actually making money here?
Our first gauge is called the gross profit margin. The formula is right there. You take your gross profit, divide it by net sales, and multiply by 100 to get a percentage. But okay, what does that number really tell us?
Well, simply put, it shows you how much cash is left over from your sales after you've paid for the direct costs of whatever it is you're selling. Now, a high margin is a fantastic sign, right? It means your core business is really healthy. But keep in mind, what's high can be totally different depending on the industry. A software company's margin is going to look way different than, say, a grocery store's.
Okay, moving on to our next gauge, net profit margin. This one is a big deal. People often call it the bottom line. The formula is net income divided by net sales, and it takes us a huge step beyond just gross profit.
So after every single bill is paid, we're talking rent, salaries, taxes, interest, the whole shebang. This is the number that shows you how many cents out of every single dollar of sales the company actually gets to keep. This is the true, ultimate measure of just how profitable a business is.
Now for our last profitability gauge, we have return on equity, or ROE. This ratio is absolutely crucial for investors. What it does is measure how much profit the company is generating for every single dollar that shareholders have put into it. A nice, consistently high ROE, that's a great signal that management is doing a fantastic job using investors' money to grow the business.
Okay, the engine is looking powerful. But what about the fuel in the tank? That's liquidity. And believe it or not, a company can look really profitable on paper but still go bankrupt if it just can't pay its immediate bills. So these gauges, they're all about short-term survival.
Our main liquidity gauge is the current ratio. It's a really simple but powerful formula. You just take the company's current assets, that's basically stuff that can be turned into cash within a year, and you divide that by its current liabilities, which are all the debts that are due within a year.
So at its core, this ratio answers a super important question. Do we have enough stuff on hand right now to cover all the bills that are coming up soon? As a general rule of thumb, a ratio of 2 to 1 is considered pretty healthy. It means you have $2 of assets for every $1 of debt you owe, a nice little cushion. Now for an even stricter test, we can use something called the quick ratio. You might also hear it called the acid test. And just look at the formula there. Notice that key difference. We take the current assets, but this time we subtract the inventory before we divide by the liabilities. So why do we do that? Well, because inventory can sometimes be really hard to sell quickly, right? So this test asks an even tougher question. If we had to pay all of our short-term bills today, like right now, could we do it without having to sell a single thing from our stock? It really is the ultimate stress test for a company's cash situation.
All right, so we've got a powerful engine, we've got a full tank of gas. Now let's check our mileage. The efficiency gauges tell us how well a company is actually using its assets to make sales. Are we a lean, mean operating machine, or are we just wasting a bunch of resources?
So a really key efficiency gauge is inventory turnover. You calculate it by dividing the cost of goods sold by the average inventory. This ratio is all about speed and movement.
What this tells you is exactly that. How many times in a period, usually a year, does the company completely sell through and replace its entire inventory? A high turnover number is fantastic. It means sales are strong and management is on top of things. A low number, though, well, that could mean products are just sitting on the shelves collecting dust.
So now we've got our readings for profitability, liquidity, and efficiency. But the real skill, the magic really, comes in knowing what to do when those gauges start flashing warning lights. This is where analysis becomes a seriously powerful diagnostic tool.
This right here, this is the classic trap. On the left, you've got a company that looks like it's absolutely crushing it. Huge revenue growth, shiny new equipment. But then you look at the dashboard and you see the dangerous reality on the right. They've got negative cash flow, a crisis-level amount of debt, and their costs are so bloated they're eating up all the profit. This is exactly how a successful company can suddenly fail.
And that debt-to-equity crisis we just saw, that is a massive flashing red light. And this is the ratio that reveals it. By dividing total liabilities by shareholders' equity, you get to see how much the company is relying on borrowed money versus its own funds. A high ratio means it's running on fumes, and just one bad month could bring the entire house of cards tumbling down.
So after looking at all these gauges, profitability, liquidity, efficiency, and all those warning lights, your role really changes. You've moved way beyond just recording numbers. You are a financial analyst. You can now interpret the dashboard, you can diagnose the health of a business, and you can tell the true story behind all the numbers. And let me tell you, that is an incredibly powerful skill to have.
So, I'll leave you with this. You now have the tools to read the financial dashboard of pretty much any business. The next time you look at a company, it could be your own, your employer's, or even one you're thinking of investing in, ask yourself, now that I can read the dashboard, what's the hidden story it's really trying to tell me?